This topic I want to cover is U.S. equity markets. Now, clearly it's a really big topic because there is trillions of dollars invested in U.S. equities. We've seen two crashes of significant proportion in the last 15, 16 years. We've seen bull markets, bear markets, volatile markets. We've seen dot-coms take off and housing and such take off. We've seen them both crash. We've seen the proliferation of the technology industry and social media companies, international, emerging markets coming out of nowhere. But I want to focus right now on U.S. equity markets, help us understand them a little bit better, how they move, why they move, and what we should be looking out for when we invest in U.S. equities. Now, the first thing, I get to go on CNBC quite a bit and talk about different stocks that are out there, and generally when people see the market up, they get all excited. And what's interesting to note is right before the last crash, 2008, we literally had, through September of that year in 9 months, 203 inquiries to become a new client, invest in the markets, at the all-time worst time. 6 months later, when it was the all-time best time to invest in equity markets, you could hear crickets in my office. I was a Maytag repairman. Nobody was calling. So we have to be careful. The human tendency is to buy high, sell low. So how do we understand when markets are high, when they're low? We can look at charts and see things going up, and say, gosh, I got to get in. Well, isn't that probably the worst time to buy? Or we see something go down, down, down. Well, I got to buy it because it's low. Well, maybe it's low for a reason. Well, how do we sift through all this information? All the talking heads on TV, most of them aren't even licensed to give financial advice. They're entertainers. Kramers and Susie Ormans, they're entertainers. So that's not a good place to get your advice either. So I want to really focus on the thing that I look at when addressing the valuation. Are we overvalued or undervalued? When I look at an individual U.S. stock or at the various sectors or the broad market, the S&P 500. So the thing that I look at is essentially called the 5-year forward PEG ratio. I may have gone over your head. I'll explain that. Why do we buy a stock in a company? Well, we buy it because we believe that as we invest money in it, whatever we invested, our share of that company's profits is going to be great in the future because they're a good company that's going to have growth in sales and they're profitable and they have a good business plan. That's what we're investing in. So a lot of people will say, well, gosh, I love XYZ company. I just love it, and I would buy it any time. I say, okay, so you love company. It's $100 a share today. You love it, right? I say, yeah. Well, what if it was $200 a share? Doesn't matter. I'd buy it. Okay, $1,000 a share. I'd buy it. $100,000 a share. And they go, whoa, that's ridiculous. No, I'm making my point here. I like company at $100 a share. I love company at $30 a share. I hate it at $2,000 a share. So the same company I might love or hate. Why is that? Well, because at $30 a share, it might be earning $4 or $5 per share per year, which gives me a humongous rate of return on my investment. At $2,000 a share, I'm earning $1.98 per share. And it's not worth to pay that much for that kind of earnings. So it's earnings that matter, growth of earnings, and how much you're paying for that stock. And that's the price-earnings ratio. The price-earnings ratio, simply put, means, let's say the company was trading at $100 a share, and they were earning $5 per share profit. You take the 100 over 5, it's trading at 20 times earnings. Well, is that good, bad, or indifferent? Actually, historically speaking, that's not that good. We're really looking for about, historically speaking, the average is about 15 times earnings. But there's a secondary component. What if they're growing those earnings year after year at dramatic amounts, and they're going to be at much higher profit levels in the future? Well, that's where the G of the PE ratio is just PE. I talked about the PEG ratio, P-E-G, and the 5-year forward. What that means is this ratio can be used to address the present value of future net profits from a company relative to what you're paying for those profits. And the net profits of the future are a combination of all 680 analysts, for instance, that cover the S&P 500 companies. So if we could download all of that data, sift through all of their reports, and get the present value of their earnings projected, we can look at any company and say, does this make sense to buy at its current price? We can look at any sector and say, does this make sense? Time and time again, buying when companies are making lots of profit but their share price is low has been very good for investors. Time and time again, .com, when we're buying share prices at a high level and they have no or low projected net profits, it's not a good time to buy. That's what creates crashes. We've seen it in the real estate industry. It's almost the same concept. Let's say you have a $100,000 rental house and it rents out for $1,500 a month. That's a great buy if you're a landlord. But what if that same $1,500 was a $600,000 house? That's not a very good return. So when prices got too high and the rents weren't higher, they were overpriced. Essentially, their price-earnings ratio was no good. But if you can buy them when they're low, that's a good time to buy anything. Stocks, real estate, you name it. So right now, we can see that the U.S. equity market has been the golden child of investments lately, as the foreign markets, as of the date of this recording, have been dropping, and the commodities and energy areas have been dropping. The U.S. markets have been going up in value. But are they overvalued? I'm asked this a lot. And I'm going to respond by saying it depends. It depends on whether you're buying the average, let's say the S&P 500, where they buy the most of the biggest companies and the least of the smallest, without regard to profit. When you buy into the Vanguard 500 index or any like-kind index, you're buying high right now. Those stocks are overvalued. But it is possible to buy stocks and funds that don't look at how big you are, but instead look at what is your projected profit relative to what we're paying for that profit. Some of those I've seen can be up to 40% discount to fair market value in the current environment, whereas I would contend that the S&P 500 right now is overvalued by at least 20%. So it's important as you analyze your own equity stock positions that you understand the difference between, are you buying low or buying high? And I would recommend, I didn't make this up, I think Warren Buffett did, but I didn't make this up, buying low is better than buying high if you're an investor. And so you can analyze those areas by looking at the 5-year forward PEG or PEG ratio.